In 1792, when Congress created the U.S. Mint and legally defined the dollar, the goal wasn't ambition or ideology. It was practicality. The young nation needed a stable unit of value to support trade, taxation, and basic economic function. A dollar meant a specific weight of silver. Gold had its own fixed value. Money was something people could measure, verify, and rely on. Stability wasn't just preferred, it was necessary for survival. But over time, that structure changed. Governments and banks shifted toward a more flexible system based on credit, lending, and financial instruments that had no physical anchor. Each adjustment made sense at the time. More liquidity during crises, more tools for growth, more freedom for policy. Yet each adjustment also increased dependence on borrowing. Step by step, the world built a financial framework where debt became the primary fuel, not a temporary tool, but a permanent requirement. Economic growth depended on it. Government budgets depended on it. Corporations relied on it to expand, and households relied on it to maintain living standards. The original idea of money as a stable measure faded, replaced by a system where value is constantly rewritten through interest rates, bond markets, and expanding credit. Today, that system has scaled into more than $300 trillion in global debt. It influences every country, every market, and almost every major decision. Most people don't see the machine directly. They only experience the outcomes: rising costs, persistent instability, and a sense that something is tightening around them. This is how that machine was created, and why the world can't seem to escape it. Every major financial system begins with a simple problem: how to create stability in a world that constantly shifts. In the late 18th century, the United States was a fragile young country struggling to define almost everything: its borders, its laws, its identity, and, just as importantly, its money. The American Revolution had ended with independence, but not with clarity. Commerce was inconsistent. Trust in paper currency was almost non-existent. Everyday transactions were difficult because no one agreed on what a dollar truly was. This was the environment Alexander Hamilton stepped into as the nation's first Treasury Secretary. His task wasn't creative, it was corrective. America needed a monetary system that everyone could understand and rely on. Hamilton believed the solution lay in grounding the dollar in specific amounts of gold and silver. He didn't design this system as an economic experiment. He designed it as a practical foundation for national survival. A stable unit of value would support trade, encourage investment, and give foreign governments reason to take the United States seriously. The Coinage Act of 1792 reflected this thinking. It created the U.S. Mint, defined the appearance of coins, and determined the precise metal content of each denomination. A dollar was not symbolic or flexible. It was measurable: 371.25 grains of pure silver. Gold coins followed a fixed value in relation to silver. This clarity mattered. A farmer selling grain, a merchant shipping goods, or a craftsman buying supplies could all operate with the same understanding of value. Nothing about the system was theoretical. It was meant to work in the real world. But building operational stability in a new nation was never simple. Even during the early decades, the country experienced currency shortages, metal outflows, and competing pressures from regional interests. Gold and silver were finite, and the nation's access to them fluctuated with trade imbalances and international events. This created tension between policymakers who wanted strict adherence to metal-based money and those who believed the country occasionally needed more flexibility. The first major test came with the creation of the first Bank of the United States. Although it issued banknotes that circulated widely, the notes were redeemable for gold or silver, which kept the system anchored. Still, critics worried that even this level of credit signaled the beginning of something larger, a slow shift away from metal toward paper promises. Their concerns were not unfounded. The early republic was already discovering that managing money required trade-offs: stability versus flexibility, restraint versus expansion. Another challenge emerged as the economy began to grow. With expanding populations, newly opened lands, and increasing commercial activity, the demand for money grew faster than the supply of precious metals. Hard money was reliable, but it was limited. This scarcity pushed states and private banks to issue their own notes, each backed by varying levels of reserves. Some were trustworthy, others were little more than educated guesses. The federal government tried to maintain order. But the reality was that money had begun to take two forms: the officially defined metal coins and the expanding universe of paper claims on those coins. This was the beginning of a structural divide that would shape the next 2 centuries. The official system, built on strict definitions, coexisted with a practical system driven by convenience and economic pressure. People increasingly used paper notes because they were easier to carry and trade. Banks preferred issuing them because doing so allowed more lending. Governments tolerated them because they supported growth. Yet the value of those notes always depended on the assumption that they could be converted into real metal. As the 1800s progressed, the tension intensified. Wars required financing, infrastructure required borrowing, economic downturns required intervention. Each challenge pushed the United States further toward a system where credit played a larger role. The Civil War accelerated this shift dramatically. Faced with extraordinary costs, the federal government issued greenbacks, paper money not backed by gold or silver. This decision solved the immediate problem of funding the war, but created a new, long-term challenge. Once a nation becomes accustomed to flexible money, it becomes difficult to return to strict limits. After the war, attempts were made to restore the gold standard and enforce convertibility. These efforts worked on paper but were difficult in practice. Gold shortages forced periodic crises. The Panic of 1873, and later, the Panic of 1893, illustrated how vulnerable the system was when large parts of the economy depended on credit, but the underlying money supply remained restricted. Every downturn brought the same dilemma: either maintain strict metal discipline and let the crisis deepen, or loosen the rules to stabilize markets. By the early 20th century, the pressures were too great to ignore. The United States needed a more flexible system to manage national growth, respond to shocks, and coordinate banking activity. This led to the creation of the Federal Reserve in 1913. Its mandate was to regulate credit, stabilize the financial system, and provide emergency liquidity. The dollar was still nominally tied to gold, but the balance of power had shifted. The Fed could now expand or contract the money supply through lending and monetary policy. This marked a key turning point. The U.S. had officially introduced a central authority capable of altering the supply of money without changing the stock of physical metal. World War I and the Great Depression further revealed the limitations of gold-based discipline. As global economies strained, countries began suspending convertibility, devaluing currencies, and using monetary tools to soften shocks. By 1933, domestic gold convertibility ended. In 1971, international convertibility ended as well. With those decisions, the foundation laid in 1792 was fully replaced. Money was no longer a measure of metal. It was a measure of policy, credit, and confidence. But the origins of the $300 trillion debt machine stretch back even further than these events. They stem from the initial compromises made in the early republic: the coexistence of precious metal coins and paper claims, the reliance on credit to support growth, and the belief that the system could balance stability with flexibility. Over time, flexibility won. Credit became essential, debt became expected, and the forces pushing for expansion became more powerful than the forces demanding restraint. By the end of the 20th century, the world entered a new phase. Money was now almost entirely credit. Governments issued bonds to finance spending. Corporations borrowed to expand. Consumers used loans to maintain living standards. And financial institutions developed increasingly complex instruments that multiplied debt far beyond the capacity of any metal-based system. The origins of the modern debt machine were not accidental. They were the product of 2 centuries of decisions, each one reasonable in its moment, each one expanding the system's capacity, and each one making debt more central to how economies function. The machine did not appear suddenly. It was built slowly, layer by layer, starting with the earliest efforts to stabilize American money. What began as a measured system anchored in silver and gold has evolved into a vast, interconnected network of obligations. that now shapes nearly every part of modern life. By the early 20th century, the United States had moved far from the metal-based discipline of its founding era. The creation of the Federal Reserve in 1913 signaled a new approach. Money would now be managed, adjusted, and expanded according to economic needs, rather than limited by physical supply. This shift didn't immediately create instability. In fact, it solved several chronic problems: inconsistent access to credit, periodic liquidity shortages, and the inability to respond quickly to financial panics. For a time, the system seemed to work exactly as intended. The First World War accelerated this transformation. Government borrowing surged to finance the conflict, and the Federal Reserve played a central role in supporting the effort. Large-scale public debt became normalized, banks expanded their lending to meet wartime production demands, and households were introduced to new forms of credit, including installment loans for consumer goods. The idea that borrowing was a temporary necessity slowly gave way to a broader acceptance of debt as a regular part of modern economic life. The 1920 seconds reinforced this mindset. The decade became synonymous with expanding credit mortgages, auto loans, margin borrowing, and business financing all grew rapidly. The United States was no longer operating on a system where money represented stored value. Increasingly, money represented expectations. Borrowing allowed citizens to buy homes they couldn't yet afford, corporations to grow beyond their savings, and the government to plan for a future that hadn't yet arrived. Credit had become the lifeblood of the economy. The Great Depression exposed the vulnerability in this arrangement. When confidence collapsed, the machinery of credit froze. Banks failed, businesses closed, and borrowers defaulted. The gold standard, already strained, became untenable. President Roosevelt's decision in 1933 to suspend domestic gold convertibility was not an attempt to reinvent money, but an attempt to keep the system from breaking completely. With gold no longer serving as a constraint, the government and the Federal Reserve gained greater freedom to inject liquidity, support banks, and stabilize financial markets. World War II marked another pivotal expansion. The scale of government borrowing during the war was unprecedented, but unlike previous crises, this time the system absorbed it smoothly. Public debt soared. Yet the economy grew rapidly due to industrial mobilization and post-war demand. Debt no longer looked like a sign of weakness. It looked like a tool that, if managed well, could fuel national strength. This perception became central to the next phase of the system's rise. The decades that followed cemented the role of credit as a permanent driver of growth. The GI Bill encouraged homeownership through federally backed mortgages. Corporations tapped bond markets to fund factories, research, and expansion. The government discovered it could support employment and stabilize the economy through deficit spending. Banks evolved from conservative intermediaries into engines of credit creation. By the 1970 seconds, however, the strain on the old monetary framework became clear. Maintaining international gold convertibility under the Bretton Woods system was impossible when the United States was issuing far more dollars abroad than it could redeem. In 1971, President Nixon ended the dollar's connection to gold for foreign governments. That single decision completed a process that had been unfolding for decades. Money was now fully abstract. It existed because institutions declared it existed, not because it was tied to a physical resource. This opened the door to rapid expansion. Without the restraint of metal convertibility, governments could run larger deficits. Banks could issue greater volumes of loans. Financial markets could develop increasingly complex instruments. The system grew in size and sophistication, and with that growth came dependence. Economies that had once relied on savings and productivity now relied on continuous borrowing to maintain stability. The 1980 seconds and 1990 seconds accelerated this further. Pension funds, insurance companies, and investment firms demanded higher returns, pushing the financial sector toward more aggressive strategies. Debt levels rose across governments, corporations, and households. For the first time, the world began to operate as a single, interconnected financial network, a system where credit flowed instantly. Investment moved freely, and a disturbance in one region could ripple across the globe in hours. By the early 21st century, The system had become enormous. Housing markets relied on mortgage-backed securities. Corporations depended on cheap credit to maintain profitability. Governments used deficits as routine policy tools. Consumers used loans for education, vehicles, and daily expenses. Debt wasn't a temporary condition. It was structural. The stability of the system depended on its own expansion. If borrowing slowed, growth slowed. If lending contracted, recessions formed. The machine had evolved into something self-sustaining, but only as long as it kept moving. The rise of the modern debt-based economy wasn't driven by recklessness or malice. It was driven by a series of rational decisions made over generations, each intended to solve an immediate problem. The country needed liquidity, so it created a central bank. It needed flexibility, so it suspended gold convertibility. It needed stability, so it used deficits to manage downturns. It needed growth, so it encouraged credit expansion. Every step was understandable. None seemed irreversible, yet together, they built a system that can no longer function without continuous borrowing. By the start of the new millennium, the foundation was clear. Money as originally defined, a fixed unit of value, had been replaced by money defined through policy, markets, and expectations. The world had embraced debt not merely as a tool, but as the core mechanism through which economies operate. The rise was complete. The system was powerful, global, and deeply entrenched, but in its strength, new vulnerabilities were emerging. Vulnerabilities that would eventually expose the limits of a world built on ever-expanding obligations. By the early 21st century, the global financial system had grown into a structure so large and interconnected that few people fully understood how it worked. Debt was everywhere in government budgets, corporate balance sheets, financial markets, and household finances. The deeper issue was how the system had evolved to depend on ever-increasing levels of borrowing to remain stable. This dependency created incentives, pressures, and behaviors that slowly undermined the system's integrity. The first sign of structural corruption emerged in the financial sector. Banks had once been institutions that managed deposits, issued loans, and maintained reserves. But as credit became the engine of economic growth, the role of banks shifted. Mortgages, car loans, credit card receivables, everything became part of a chain of financial products that could be sliced, repackaged, insured, and sold to investors. The value of these products didn't come from their connection to the real economy, but from the expectations built into them. This created a fundamental conflict. Institutions responsible for evaluating risk were also incentivized to expand it. Lending standards loosened. Complex instruments multiplied. Debt no longer reflected a borrower's ability to repay. Governments found themselves trapped in a similar dynamic. Politicians learned that borrowing was easier than raising taxes or cutting spending. The public grew accustomed to programs, subsidies, and services funded by deficits. During downturns, countries relied on central banks to stabilize markets through emergency lending and asset purchases. These interventions were rational in the moment, but they created long-term consequences. This moral hazard grew more pronounced as financial crises became more frequent. The dot-com crash was absorbed through monetary easing. The housing bubble was fueled by cheap credit. The 2008 financial crisis revealed how deeply the system had diverged from its original purpose. Mortgage-backed securities imploded, banks failed, and global markets entered a synchronized panic. Yet despite the shock, the solution was the same. More borrowing, more liquidity, more intervention. Central banks around the world lowered interest rates to historic lows and injected trillions into the financial system. These actions prevented a complete collapse, but also entrenched a new reality. Economic stability now depended on central banks maintaining low rates and constant support. Markets rallied, asset prices soared, and debt expanded to new heights. Corporations borrowed to buy back shares. Households took on larger mortgages. Governments postponed fiscal corrections. The conflict wasn't ideological. It was structural. A system built on expanding credit could not afford contraction. Debt had become the mechanism through which economies delayed consequences. Each cycle of intervention pushed the system further from genuine stability and deeper into dependence. Globalization intensified these vulnerabilities. Capital moved across borders instantly, allowing shocks to spread with unprecedented speed. Emerging markets borrowed heavily in foreign currencies, making them vulnerable to dollar fluctuations. Advanced economies relied on complex financial instruments that magnified risk. Supply chains, investment flows, and national budgets all became entangled in a network where a disruption in one region could destabilize others. By the 2010 seconds, the world had entered a new phase of imbalance. Interest rates hovered near zero. Public debt in major economies reached levels once considered unthinkable. Corporate debt surged as companies refinanced at low costs. Consumers accumulated credit for education, healthcare, and housing. Even though the global economy appeared stable, it rested on an assumption that borrowing could always expand. The structural corruption wasn't about criminal acts or hidden conspiracies. It was about a system drifting further from the discipline that once defined it. It had become the foundation of modern economic life. At the heart of the conflict was a simple truth. The system demanded growth, but real productivity growth was slowing. To fill the gap, credit filled in, then more credit. And eventually, an entire economic model emerged where the promise of future income, future taxes, and future stability had to be constantly leveraged to sustain the present. The $300 trillion debt machine did not arise because of a single decision or failure. It grew because the system rewarded expansion and punished restraint. Every actor, governments, banks, corporations, households, adapted to that logic. The conflict was no longer between nations or institutions. It was between the system's original purpose and the form it had taken, between stability and dependence, between what money used to represent and what it had become. By the 2020 seconds, the global financial system reached a point where its internal contradictions could no longer be ignored. The world had built an economy dependent on continuous borrowing, yet the ability to sustain that borrowing was weakening. Growth slowed. Populations aged, productivity gains flattened, and governments struggled with rising obligations. The system that once promised stability now carried an unavoidable question. What happens when a structure built on debt becomes too large to support itself? The first major stress test came during the global pandemic. To prevent economic collapse, governments and central banks responded with extraordinary measures. Trillions in fiscal stimulus, near-zero interest rates, expanded asset purchases, and direct financial support to households and businesses. These actions kept the global economy from falling into depression, but they also accelerated existing trends. Public debt skyrocketed, corporate leverage increased, and central banks became even more central to financial stability. The system survived, but at the cost of deepening its dependence on interventions. When inflation surged in the years that followed, it exposed a core vulnerability. That stability masked the risks accumulating beneath the surface. Once inflation returned, central banks were forced to raise interest rates sharply. The result was immediate and revealing. Governments faced higher borrowing costs, corporations struggled to refinance, and households felt pressure through housing markets and consumer credit. Even small rate increases created disproportionate stress because the entire system had been built on assumptions of cheap debt. This was the turning point. Not a dramatic collapse, but a realization that the model could not continue indefinitely. The machine no longer functioned smoothly under higher rates. Yet lowering rates risked reigniting inflation. Policymakers found themselves trapped between two undesirable outcomes: financial instability on one side, price instability on the other. The tools that had sustained the system for decades no longer offered easy solutions. Meanwhile, global fractures widened. Several developing nations faced debt crises as rising interest costs made repayment impossible. These events were not isolated failures but symptoms of a broader structural issue. Countries had borrowed heavily during years of low rates, assuming those conditions would last. When conditions changed, their financial architecture could not adjust. Even advanced economies were not exempt. Larger governments faced growing debt to GDP ratios, with long-term obligations such as pensions, healthcare costs, and social programs expanding faster than revenues. Every budget cycle revealed the same pattern. More borrowing was required simply to maintain existing commitments. Structural reforms were politically difficult, and cutting spending risked public backlash. The debt machine had locked governments into a cycle where yesterday's promises required tomorrow's borrowing. In the private sector, corporations that had spent years leveraging cheap credit encountered new pressures. Refinancing became more expensive. Profit margins tightened. Companies that had prioritized stock buybacks over long-term resilience found themselves exposed. Some sectors, especially real estate and high-yield borrowing, experienced significant stress. The system had rewarded expansion during low-rate periods, but offered little cushion when conditions reversed. Financial markets responded with volatility. Investors tried to anticipate policy changes, leading to rapid swings in asset prices. Each shift in interest rate expectations triggered reactions across housing, equities, bonds, and commodities. Market behavior resembled a system searching for stability that no longer existed. Yet despite these pressures, the global economy did not collapse outright. Instead, it entered a prolonged phase of adjustment, characterized by slower growth, higher borrowing costs, and greater sensitivity to shock. Governments experimented with new tools, targeted subsidies, selective debt restructuring, and attempts to regulate financial flows. Central banks refined their communication and balance sheet strategies. Some countries rethought industrial policy and energy security. Others pursued financial reforms aimed at reducing vulnerability. This period marked the beginning of a transformation, not by choice but by necessity. The debt machine had reached its operational limits, and the world could no longer rely on endless expansion to fuel prosperity. New approaches, some successful, others unclear, began to emerge. More countries explored alternative reserve arrangements, digital currencies, and cross-border payment systems. The goal was not to dismantle the global financial order, but to create a system capable of functioning under new constraints. The transformation was uneven, incomplete, and ongoing, but one principle became increasingly apparent. Stability would have to be rebuilt, not through unlimited borrowing, but through structural changes in how economies measure value, manage risk, and distribute opportunity. The era of effortless credit was ending, and a new chapter defined by adjustment and realism instead of expansion was beginning. The global debt system did not emerge overnight, nor will it disappear quickly. Its legacy is woven into the structure of modern life. Governments rely on it to fund essential services. Corporations depend on it to operate and expand, and households use it to bridge the gap between stagnant wages and rising costs. Debt has become so embedded in economic function that any attempt to reduce it meaningfully risks triggering instability. This is the paradox that defines the modern financial era. The world is aware of the problem, yet deeply reliant on the very mechanism causing it. One of the most significant consequences of the $300 trillion debt machine is the way it reshaped expectations. For generations, economic growth was viewed as both normal and permanent. But much of that growth was powered by ever-expanding credit. When credit became the default engine, societies grew accustomed to rising asset prices, easy borrowing, and government programs supported by deficits rather than revenues. The system created prosperity, but it also created fragility. When growth slowed and borrowing costs rose, the underlying vulnerabilities were exposed. Another part of the legacy is inequality. Those closest to the financial system, large corporations, investors, and asset holders, benefited the most from easy credit and rising valuations. Meanwhile, younger generations and lower-income households faced higher barriers to homeownership, education, and financial stability. The system didn't set out to create these imbalances, but its structure amplified them. Debt became a tool some used to get ahead, and others used merely to keep up. Yet, perhaps the most enduring impact is psychological. People across the world sense that the economic environment has changed, even if they can't identify the cause. They feel the weight of rising prices, uncertain job markets, and the burden of personal debt. They notice governments struggling with deficits and political conflicts over spending. They observe financial markets reacting sharply to minor shifts in policy. The sense of stability once associated with modern economies has weakened, replaced by a feeling of constant tension. But the story does not end with decline. Throughout history, Financial systems have evolved when their underlying assumptions became unsustainable. The shift from metal-based money to credit-based money took more than a century. The next shift, whatever form it takes, will emerge gradually as societies adjust to new realities. It may involve more diversified currency systems, new forms of digital settlement, revised debt structures, or long-term fiscal reforms. Some countries will adapt faster than others. Some may resist change until circumstances force it. What is certain is that the world cannot rely indefinitely on rising debt to maintain stability. The future will require a different balance, one that values resilience as much as expansion and sustainability as much as growth. Reforms will not be easy, and they will not be uniform. But the pressures shaping the next era are already visible, and ignoring them will only delay the adjustments that must come. The legacy of the $300 trillion debt machine is a reminder that economic systems are human creations. They can grow stronger, they can drift off course, and they can be rebuilt. The challenge is recognizing when the time for rebuilding has arrived, and accepting that the process will require discomfort, transparency, and a willingness to rethink assumptions that once seemed permanent. Thank you for watching this video. Click here to watch another video that might interest you.